Hello, it is April 30th, 2012, and I am Dave Brady, your 401k plan advisor. I thought it'd be a good idea to jump in front of you today as we're kind of 4 months into the new year and talk to you about a little bit about where we've been and give some thoughts about where we might be going both short and long term. First, where have we been? The U.S. markets are up right around 12% on a year-to-date basis, so we're off to a pretty good start. Globally, it's pretty close to the same thing. We've got global markets up around 11%. The divide would be up 6 or 7% for the developed countries in Europe, and up around 12 to 13% for the emerging markets. On the fixed income side, it's been a bit of a different situation. Fixed income returns fairly anemic through the first 4 months of the year. If you look at the funds that are in the plan, the fixed income funds that are in the plan, you've got them up, say, between 0 and 4%, depending on the fund. Let's see. Okay, that's the wrap up. Now, where might we be going? Well, the Wall Street Journal today published a story about selling in May and going away. So we'll start with the market timers first. Sure enough, we've done the research here and gone back 50 or 60 years and found that about 77% of the time the market actually closes at a lower price than the April 30th closing price. So, selling very early in May and waiting for a correction or some kind of correction has been a trading strategy that works most often. The problem with that is you don't know how big the correction is going to be and when to time it to get back in. So we would say if you are active and thinking about timing and looking to take advantage of the sell in May, go away. Just be very disciplined. If we see a 5% correction, say get back in. And then we would always recommend a conservative approach to this as opposed to taking your whole portfolio and turning it into cash, maybe, lighting up on what has worked best, say, over the first 4 months of the year and looking to get back in after you've had the correction that you're looking for. So there is the advice for the traders. If you are a plan participant that just simply allocates to the default equity income fund, we think steady as she goes for you. That fund, we believe, is very well positioned for both the short and long term, some of the trends that we see developing in the market. So we would be very comfortable keeping you fully in that fund. And then finally, for you, let's say, tactical asset allocators out there with a longer term point of view, we are seeing what appears to be a bit of a sea change for markets here in the U.S. and abroad. As you know, or at least plan participants that have been around the longest, we've been pitching a growth thing pretty hard. First we started with the small and mid caps, and then we worked our way up a couple of years ago into the large cap space, and that has played itself out very well. I mean, if you look on a year-to-date basis, the large cap growth fund that we have in the portfolio is the second best performing fund. I believe the science and technology fund is right up at the top. The healthcare fund, the health science, which has more of a mid cap tilt to it, but an aggressive growth tilt to it, has performed very well as well. So that growth theme that we've been talking about really has played itself out very nicely. So much so that we feel value stocks are beginning to look underappreciated, let's say. And these are both large and small cap value stocks, and even international value stocks. So if you are thinking about tactical asset allocations, we don't recommend that you hook, line, and sinker, growth into value. But, for the 3 to 5 year time horizon type investor, we think now would be as good a time as any to begin to slowly develop allocations towards the value space. The small cap value space in particular looks attractive. So we put that Vanguard Small Cap Value Fund in there. That deserves a good look. We have the Dodge & Cox Stock Fund in there, which is a large cap value stock fund, which we think would be an excellent choice for 3 to 5 year type investors. As over that time frame, value stocks will be reappreciated, and we should see some real outperformance in the space. Let's see, what else can we tell you today? From a macro point of view, certainly we get a lot of questions on interest rates and inflation. We know that's a concern. Rates, Bernanke's made it very easy to predict, really, or to at least talk about the future. It looks like things are going to stay, relatively put for the next, say, 0 to 18 months. Beyond that, it wouldn't be unreasonable to see rates rise. So, on a 3 to 5 year basis, we're probably looking at a rising interest rate environment. As far as inflation goes, banks really have held the key to inflation. I mean, they've got this tremendous amount of excess reserve base built up at the Federal Reserve that they're not lending, are just not lending aggressively enough to cause inflation. But that money still exists, and bank lending, in fact, has picked up, say, over the last 6 to 9 months. Should that trend continue, especially if it accelerates and these reserves make their way out into the real economy, and we end up in a situation where, there's too many dollars chasing too few goods potentially, then, that certainly would cause inflation. So, inflation, should be on everybody's radar. Higher interest rates should be on everybody's radar. And those two factors, really dovetail very nicely into our value theme. Both the large and small caps value stocks should hold up pretty well on a relative basis in a rising rate inflationary environment. You might also want to take a look at the natural resource fund that we have in there. That performance has been fairly anemic over the last 5 years, but it could be time for it. And even the real estate fund. So, I mean, you bend your portfolio over time towards value stocks, towards real assets. You have a pretty good sort of growth hedge against inflation. So, okay, that's really what we wanted to get in front of and tell you. The market's up. The timers can maybe raise a little cash here. The tactical asset allocators can begin to look at the value stocks here in the United States and around the world. If you're heavily weighted in fixed income, that would be a terrific source of cash for that rotation. Probably a secondary source would be growth stocks, small and mid caps first, and then followed by large caps as you slowly work your way into the value space. The default fund investors, steady she goes. That fund is very well positioned for the themes that I've talked about. Potentially rising rates and potentially an increase in inflation. That's a very defensive fund, and we think would hold up relatively well in that kind of environment. So that's it. Again, my name is Dave Brady. Give me a call if you have any questions on what I've talked about today. Also, we're constantly looking at the fund lineup and trying to improve the mix. If there's any suggestions that you might want to see, again, don't be shy about giving me a call. We'd love to hear from you. Okay, that's it. Have a good day. Bye.